Intervalo rapidinho, né? Falei que era só uma pausa rápida. Estamos de volta com o TAG Summit 2021. Muito obrigada por estarem conosco nesta tarde. Bom, o nosso próximo painel, ele conta com convidados internacionais. Então, na sala principal do nosso evento, nós temos a tradução simultânea, caso prefira ouvir o áudio original. Então, tem uma sala ali aberta com essa opção, que vocês podem acessá-la através do nosso lobby virtual. Para falar sobre o tema... Deus pode até ser brasileiro, mas seus investimentos não devem ser 100% no Brasil. Convido os panelistas Alistair Corden-Lloyd, diretor executivo do Morgan Stanley Investment Management, Graham Robertson, sócio e head de Client Portfolio Management da MAN AHL, e Ronnie Gerder, vice-presidente e Portfolio Advisor da Compass Group. E para mediar essa conversa, temos a presença do CIO da TAG Investimentos, Dan Cava. Então já vou. Welcome to our event. Dan, palavra sua. Bom debate para vocês.
Thanks for the introduction, Vanessa. And good afternoon for our audience. Good evening for some of our guests that are based in London. Good night. And first of all, I would like to thank a special thanks for Alistair from Morgan Stanley, for Graham from Main Group, and from Ronnie from Wellington to accept our invitation to be part of this event. There is a lot of moving parts on the global economy and on the global financial markets right now, and unfortunately, we will not have time to talk about all of these issues, all of these moving parts, so we will have to spend more time focusing some of these issues. But before we start, I would like that each of you introduce yourselves and the company that you are representing here. I will start in alphabetic order, so please, Alistair, can you start?
Hello, everybody. My name is Alistair. I work at Morgan Stanley in London. I'm a portfolio specialist for our international equity team, and we specialize in investing in very high-quality companies that have powerful intangible assets. I've been at the firm for 24 years, which is perhaps a little too long, and we run around $60 billion in assets as a team.
Graham, please.
Yeah. Hello, everyone. My name's Graham Robertson. I'm a partner at Man AHL, based in London. AHL is the systematic trading arm of Man Group. Man Group itself dates back to the 1700s as a commodities broker. AHL itself has around $50 billion in systematic strategies, probably most famous for trend following. We were one of the early pioneers in the field maybe 30 years ago. And we're now a fully fledged quantitative manager with around $15 billion also in multi-asset investments, which I'm sure we'll come on to later. Myself, I've got around 25 years experience in investment management. That's spanning fixed income, credit, capital structure arbitrage, and then all kinds of alternatives at AHL itself. I'm trained as an numerical modeler. I did generated models of the Earth for about 7 years. And now I particularly enjoy kind of translating that numerical modeling into financial markets, sort of looking for new opportunities and genuinely different ways of doing things.
Thanks a lot. Ronnie?
Good afternoon, everybody. Thanks for having me today. I'm from Wellington Management. We are a global asset management firm managing roughly 1.4 trillion assets across all the different asset classes, be it equities, fixed income, as well as alternative investments. I'm working here as an investment specialist, particularly responsible for the innovation and tech strategies, particularly for the newer kind of Asian technology in investments and strategies.
Thanks a lot. So to kickstart our conversation here, I would like to talk a little bit about the pandemic and about the COVID-19. The last 1 year and a half, this is the main theme for markets and for the global economy. And between this time period, we saw a kind of mini cycles. The first cycle between February and April was the big risk-off, coordinate global risk-off when the COVID spreads around the world. Then between April and the end of the year, around November, we saw that V-shaped recovery, but leading by the stay-at-home plays and the technology companies moving up and leading this movement. And from November, December until April, May of this year, we saw the reflation trade. We saw Biden being elected in US. We saw the start of the vaccination campaign on the developed world. It seems that we are in a period of consolidation. Markets are starting to try to figure out what's the next movement. The pandemic seems to be controlled, but we are seeing some pockets of new infections starting in UK, now in US, China. So my question is for Alistair. What lies ahead in terms of the pandemic and how this could affect the global growth and global markets?
Well, if we just reflect a little bit back on what you've just said, and rightly it's been a two-stage event affecting price and affecting fundamentals. You know, the arrival of the virus caused that powerful shock to markets early last year, 20% fall in the world index at the time. Then you had the arrival of vaccines that stimulated a very sharp recovery, and markets are now actually higher than they were before the virus even arrived. And you know, for us, it's perhaps useful to reflect through that window how it affected our companies, because if the virus is to persist, that could influence how our companies in particular would be affected. So inside our portfolio, behavior was closely linked to the hindrances and behaviors that the virus created. You know, our healthcare companies helped in vaccine discovery, they helped in testing, they helped in diagnostics. Our household and personal care companies, they sold significantly more hygiene products, and our software companies clearly saw a considerable uptake in communication and collaboration software as the working population really very successfully shifted from offices to their homes, and they're still in their homes. But where we saw difficulty was understandably in the beverage industry because of lockdowns, in cross-border transactions because of travel restrictions, which are still largely in place, and lockdowns are coming back in various forms and various sort of levels of aggression. You see in Australia, for example, very strong efforts to contain the virus because they got a low vaccination rate. And just going back to our space in elective surgery, helping people with their hips and their knees and whatever procedures they needed, they got pushed away and got pushed back. They took a back seat because of the pressing need to treat those affected by COVID. Now, this is starting to lift, and we're starting to see a very strong recovery from a very, very brief shock. So when you're looking at like-for-like numbers, they're all over the place. We're seeing very, very strong and large numbers. But what we're pleased to see is that at a strategy level for us, our portfolios have behaved exactly in character, in fact, with previous setbacks and previous strong recoveries. It means we've had good relative downside participation. We only fell half of what the broader market fell when the virus arrived. And we participated in about 80% of the upside as the market rallied back when the vaccine solution arrived in what was record time. But this virus is modifying itself. It's creating complexity in countries that thought they might have it behind them, and now it's coming back. We're starting to see the Delta variant spread more broadly across China, for example. It's very well spread in Malaysia, where my brother lives. I get updates from him. So we're not out of the woods yet. But what we're pleased to have seen is that our companies have done what they should have done. They've provided strong relative downside protection. And most importantly, at the fundamental level, the level of earnings of our strategies has been really very resilient, and actually is higher than the broader market's earnings are relative to 2019.
Great, thanks a lot. I think if I can give my 2 cents here regarding this theme, what we are seeing, especially we saw first in UK, now we are seeing a little bit in US and China, and we just move on to China in a brief moment. What we are seeing is pocket of new cases, but hospitalization is kind of stable, and we are not seeing new waves of that. debts. So basically, I think the society is learning how to deal with the virus, and when the time passes, we have seen less economic impact than we saw 1 year and a half ago. So thank you. Moving on to China here, and a question for Ronnie that is more focused in Asia. China is dealing with 3 different issues and obstacles, I can say. First of all, a deceleration in growth, and now we are seeing a new pocket of virus, and they are closing some areas of the country. The second one is a credit problem, starting in a big real estate conglomerate, and we are seeing the bonds of this conglomerate trading at 50-60% of the par, and there is a social issue regarding the real estate in China. And the third theme, and probably the most important one for markets, has been the tightening of the regulation in some industries. It starts in the financial sector, then they move on to the technology sector, and now to the education sector. And we heard some things about the gaming sector the last couple of days. So how do you see the scenario in China, and what are the risks and opportunities, especially now that we saw the stock market in China selling off around 25-30% if we look to the MSCI China, but if you look to specific stocks, there are stocks that came down 50, 60, and on the education sector even 70 or 80%. So what lies ahead for China, and what are the opportunities that you see after these main issues?
Yeah, thanks for this question. First of all, at the moment, it's a quite attractive moment to be an investor in Asian technology stocks. There is, as you said, a lot going on with regulation. There's a lot of news in the market, and many people are currently a little bit worried. Yes, that's true. But we as fundamental investors, we try a little bit also to look through these noises. We try to position ourselves for the long-term tailwinds which this market presents, so Asian tech in general. And if you maybe speak first about regulation, yes, there have been a lot of things. They started already last year, end of October, early November, when all of a sudden the IPO of Ant Financial was postponed by the regulator. Then clearly the government in China said, we want to do an overhaul of many areas in the tech area. And this mainly comes also from the fact that many tech companies or many tech industries in China, they haven't been really regulated before. So China, to a certain degree, starts now to catch up with Western markets. What we are doing already in the US, so what we have seen with GDPR regulations in Europe, for example. So therefore, I guess we have to see a little bit to the broader kind of lenses and not being too nervous about it. So I guess what China now really tries a little bit to do is to level the playing field for the different kind of market participants. So making sure, for example, that merchants that are not forced just to choose one platform, not just to go for Alibaba or to go for another e-commerce platform. They also make sure that, for example, drivers at Didi get a reasonable take or payment, which they can take home. They want to make sure, for example, also what you mentioned before with gaming, that children do not get addicted to gaming, for example. And these are a lot of things which are, I guess, from a regulatory point of view, make absolutely sense. And they maybe also have been done, for example, in the US and other Western markets. So it's more of kind of a catch-up in terms of regulatory, what we currently see in China. And what is maybe most of the time making the investors nervous is the kind of speed. And here we have just to make one thing clear. China has another system. And when China does regulations, usually the regulations are quite, regulatory measurements are quite expanding, quite large, and they're done in a short time period. And this is certainly different to, for example, to the tech companies in the US. If there's a new kind of a lawsuit against tech companies, then they are able to counterattack, for example, this lawsuit. So they are able to defend themselves. And usually then these kind of lawsuits, they take a couple of years until it comes to an end. And in China, there's the government says which kind of direction the march goes on, and then the companies have to adhere to it. So also today was quite interesting to hear how Tencent reacted on this new kind of maybe gaming regulation, because clearly gaming could be after education, maybe the next sector which will find a little bit more kind of regulations. And Tencent already proactively went out and saying, we are increasing our measures to protect minors, to protect school children, particularly below 12 years old. And at the end, I guess this is the kind of right practice for these companies to be proactive, to be in line with the government policies. And also at the end, it does not hurt. It does not hurt Tencent to do this kind of measures, because gaming revenue from children below the age of 12 doesn't really make anything a bigger part in their revenue case. So therefore, we think in general, the fundamentals are quite good for many Chinese tech companies, but also Asian tech companies. And therefore, I guess today is a little bit too much negative sentiment in the market because many new regulations come out. But we believe that the tech companies are very well placed to cope with these new regulations.
Thanks a lot. And for our guests that have the opportunity, TAG Investimentos just released our monthly review. If you can go to our website, we talk a lot about China, and our views are pretty similar than the views from Wellington. So moving on here, Graham, you are specialized in quantitative strategies and risk premium strategies. So I would like you to explain a little bit how this works for our guests, and how do you think the technology have been affecting the investment management industry? And I'm pretty afraid that we investment professionals are going to be substitute for machines. So what's your view, and how do you think that things are moving on this space?
Great, yeah, thank you. I think, we clearly live in very interesting times. And I think that investors today are faced with a number of problems that really we haven't seen for quite some time. If I look at it, the face of it now, we have a situation where equities on a very long-term horizon are expensive. You look at a situation where bond yields, certainly in the US, are at all-time lows. And also you've got this, bond equity correlation has been negative for the last 20 years or so, which has been the perfect scenario for classic 60-40, classic multi-asset investing. So right now investors are faced with this twin problem of having to invest in traditional investments, which are really expensive by conventional methods, and perhaps there's been an environment where traditional investments have paired each other together really quite nicely, and that might not happen in the years going forward. And we think at Man Group that quantitative investing can really offer some nice opportunities, some diversifying opportunities. So let me approach that from two viewpoints. AHL's history, as I mentioned earlier, is in trend following. If you look at a trend following strategy, we've been around for 30 years. There's tried and tested track record there. Trend following strategies, almost by definition, tend to be very lowly correlated to traditional investments. We trade equities, bonds, commodities, credit, you name it, we trade it, and we can trade it from a long or a short side. And what that does is it gives investors great diversification from currently expensive assets. So on the one hand, quantitative systematic trading can add that diversification point of view as a separate investment to what people might look at traditionally. On the other hand, I think we also offer answers to people who still have to invest at long-only markets. Multi-asset investing is typically long-only across expensive equities, expensive bonds, expensive credit. Credit spreads are tight and commodities are now expensive. And I guess what the quants will bring to the table is really thinking about things in terms of risk management. Most investors will take your traditional approach to asset allocation to try and have a view of the world and then say, look, given this view, we think we should invest in equities because they're cheap, or bonds because they're expensive, whatever. Our approach is slightly different in that, we will say, well, actually, we can't predict returns. Returns are very hard to predict, and we can show that very clearly with analyst estimates of the S&P, and we can show that very clearly with the futures curve and how that predicts short-term rates of in the US. Futures curve is a very poor predictor of what is likely to happen to short-term rates. So we think returns are hard to predict, but risk is much easier to predict. And so from a multi-asset long-only point of view, instead of thinking about returns, we think about risk. And what that enables you to do is to really get out of trouble fast, if you like, really protect that downside. And it was interesting that, that you posed the COVID question to start off with, because arguably, before COVID in March last year, markets were incredibly expensive. And that's probably the same case again today. But of course, we've had a huge reversal, particularly in risk assets and in the interim through March last year. Nobody saw that coming. We didn't see that coming. But if you've got systems, risk management systems that can respond appropriately, you can really start to deal with the kind of problems that investors face in really quite a different way. And that is, I think, what systematic brings to investors at the moment. To the second part of your question, will systematic take over the world? Will machines take over the world? We don't subscribe to that. We don't see the Terminator coming through from the machines at all. We see it as a nice complement. And we think the discretionary world, I've seen that from the other participants in the panel today, there's a nice role to play. You're looking in depth at balance sheets at companies and you're saying, well, look, this is the right way to play it. The systematic approach is just different. We look at things in a different lens, and it's just it's a complementary way for people to play the markets and investors to look at markets.
Great, thank you. So picking up a little bit what you just said, that before COVID, markets in general were expensive, but nobody saw COVID coming. And nowadays we are seeing again pockets of excess in some markets. I would like to ask Alistair and Ronnie how they saw markets pricing and valuations. We at TAG, we have this view that some pockets of the market are expensive. When we look to the S&P 500, the NASDAQ, some valuations look stretched. But when we look under the surface, we are already seeing some kind of movements like in China that you just talked, but also when we look to the small cap stocks in US, some average stocks on the Russell already correct between 10 and 20%. So please, Alistair, can you talk a little bit about your views regarding prices, valuations, and even technical position?
Sure. Well, we are very focused exclusively on looking at companies that we believe are very high quality. All our strategies are high quality strategies. And from a valuation perspective, they're actually in a pretty interesting place from that point of view. You've got the combination of their robust earnings last year, but they lagged the market on price appreciation, as I said, post-vaccine discovery. And that means they've effectively derated compared to the broader market. So what you have now is a set of names that have over 3 times the return on operating capital. They have twice the gross margins of the broader market, and gross margins are an indicator, by the way, of your pricing power, which is very important in this environment. They're much less capital intensive, and they've got stronger balance sheets. And you're in this extraordinary situation now where you're currently paying very close to the same price in free cash flow terms for these very high quality companies compared to the lower quality index. And the premium you're having to pay in terms of earnings is historically extremely modest. And at a sector level, and we typically find high quality in technology, in healthcare, and in consumer staples, if you exclude what was the distortion of the credit crisis, two of our key sectors, healthcare and consumer staples, are both trading at historic lows or near to historic lows compared to the index. And it's worth remembering that, given the events of the last 18 months, that our portfolios have done what we expected them to do. As I said, they've demonstrated their resilience and their ability to compound through the noise and through the COVID event. So in a nutshell, we think that a high-quality focus should offer that. It should offer resilient earnings and reasonable relative valuations. But I wouldn't pretend for a minute that the absolute valuations are in bargain basement territory. They're not. You're having to pay a relatively full price for a high-quality company, but quite a stretched price for an average company.
Okay. Ronnie, regarding China and Asia, we saw this sell-off, more focus in China. And the last time that I saw, I think the tech companies in China was trading around 30% of discount if you compare to the US tech companies. So how do you see valuations in China and Asia in general right now?
That's absolutely true. I guess when you start talking about valuations, it's certainly something which investors should bear in mind, that the Asian tech sector in general, when we look back over the past 5 to 10 years, has clearly lacked in terms of performance versus Western technology sectors. And this leads then also in turn to the fact that today, relatively to the global tech sector, Asia tech has a more attractive valuation, particularly also after the recent weeks and months, but at the same time offers a higher growth expectation versus global technology. So therefore, this is a quite important input for somebody who maybe thinks to invest in technology, not to forget the Asia tech bucket. And just maybe let me shortly also mention one important thing about Asia tech or the Asian tech investment landscape in general. When we look today at market capitalizations, still roughly 70% of global tech market capitalization is in Western technology. So it's not in Asia tech. However, when you look on turn to the investment opportunity set in terms of number of tech companies, then roughly 70% of the global investment opportunity is in Asia. So today, Asia is home to roughly twice as many tech companies as the US and Europe are combined. And therefore, this is a really broad opportunity set. And also would like to mention here, we discussed before about China. But China is not just Asia tech, or Asia tech is not just China. We see currently very attractive investment opportunities, particularly in Taiwan, in Japan, in Korea. So these are for us the core markets when it comes to invest in Asia technology. And maybe also now to compare it a little bit with what you said before, post-pandemic. If you remember last year when the pandemic broke out, I guess we as society were never better prepared to face such a pandemic than we were, also thanks to many technologies we have at hand today. So people were working from home, we needed more data capacity, we needed more cloud computing, we needed more collaboration tools, for example, we needed more lenses, sensors, etc. And these are all kind of materials and components that are today to a very large degree produced in Asia by Asian tech companies, which are highly innovative and have a very strong market position. So therefore, I would say through the pandemic, but also now going out of the pandemic, the Asian tech companies in general are very well positioned in terms of growth and also now in terms of valuation. For example, we see companies like Alibaba and Tencent very attractively valued currently. But also said the kind of long-term runway for growth for Asian tech companies is certainly in place because they deliver the solution for the society to come out of the pandemic. And maybe just let me making a last comment about an interesting investment opportunity in Japan is a company called Ushio. They just came out end of last or in 2020 with a new kind of ultraviolet light source, which is a kind of new innovation which allows to kill 99.9% of all viruses known, including the COVID-19 virus, just by light, just by this ultraviolet light. So this can be now applications that you can use in airports, in stations, in hospitals, etc. Everywhere, and a lot of people are walking around, and you can use this kind of interesting applications for killing this kind of viruses. So companies, Asian tech companies are delivering many solutions and give many solutions in the hand of the society to really come out of this pandemic. And therefore, we think this is a quite highly interesting market pocket.
Nice, thank you. Graham, there is a big debate around the world regarding active and passive investments. Here in Brazil, we are starting to see a boom in some passive ETFs. I know that you guys in Europe and in US have seen this scenario going through for the last decade or so, but this is something quite new here in Brazil. So I would like to understand what's the main group view regarding active versus passive strategies. If you use passive strategies in your funds and in your strategies, and then if you could complement how main group use on these quantitative strategies, prices, valuations, and technical positions to build a portfolio.
Absolutely. Yes, we are very much of the active variety. Active is very much baked in to everything that we do. I mean, if we think about trend following, for example, trend following is all about responding to the market environment. You know, if prices are going up, we're building into position. If prices are going down, we're generally cutting positions and going short. And we'll do that across as many liquid markets as we possibly can. So we're really very much on the active side, both in terms of our signals, the way we trade, such as looking at trends, but also in terms of our risk management. So for example, when we see a big spike in volatility, when market risk picks up, generally speaking, we're cutting our positions just so that, you know, investors can sleep at night, so that you're maintaining a constant level of risk rather than running very high risk just because the VIX hits 80. For example. So active is very much a cornerstone of what we do. In terms of valuations, again, we probably look at that a little bit differently. So we love situations where markets move a lot. Trend following by its very nature is a strategy that loves bubbles in markets. You know, we love it when markets go sky high valuations, and conversely, we love it when market valuations plummet, because these represent trends, and those are things that our active systems can deal with. So, in a sense, something that is very hard to value is probably something that we would be more interested in, because there is more scope for a price to deviate from what the market actually thinks it might be. And maybe there's one example out there that to me is a very good example of that, and it's cryptocurrencies and Bitcoin, for example. Here is something where the fundamental value of that is clearly in great debate. And we've seen two enormous bubbles in Bitcoin in the last, whatever it was, half a dozen years or so, and similarly crashes. Valuation of Bitcoin is very hard to establish, arguably much higher than in equity markets, for example. And that's something, again, that, you know, an active strategy can potentially take care of. So, again, the systematic side can really give you quite a differentiated approach to the classic fundamental way of valuations and that you might get in equity markets.
Great. I'm kind of curious right now. Is there any big signal that the models are showing right now? So the models at the moment are largely sitting in fairly long positions. And if we look at, again, trend following as an example, you know, we've seen equities rising of late, so our positions in equities are typically long. The themes in the markets at the moment, arguably inflation has been a rather dominant theme in the market, so commodity positions tend to be quite long, so we'll typically be long with rising natural gas prices, you know, rising wheat, corn, and rising copper, etc. Fixed income, for that matter, has probably been the more interesting one. We saw fixed income yields backing off in Q1 this year. We saw yields rising, prices falling, and as a result, our systems responded to that and got flat to short fixed income. So really picking up that inflation theme, you know, long commodities, short fixed income. Then that's reversed somewhat in Q2. We've seen equities rise, we're still long equities. We've seen commodities continue to rise, we're still long that. But with the collapse in yields, with yields coming down again, we've started to come into a more
rounded along fixed income stance as well. So that's what the models are telling us at the moment. They're responding to what's in the market, and that tends to be what we do.
Thank you, great. And Alistair, I think the other main macroeconomic theme that we have been dealing with is inflation. So there is this big debate if inflation is going to be transitory or permanent. The Fed has been insisting that inflation is going to be transitory. Then they start talking or changing a little bit the tone. Just before coming here, I was just watching Fed Governor Clarida, and he has a much hawkish speech regarding tapering at the end of this year and the Fed dual mandate. And I have been hearing for the companies in some sectors that they have to deal with inflation, margin compression, and so on. So what you guys are seeing on the corporate side, on the companies that you invest and that you cover, on this theme about inflation, it is going to be only transitory, or some of this inflation is going to be permanent, and how this is affecting the corporate side of the business?
Well, from our perspective, as you know, as part of our quality assessment, and actually an advantage of owning companies that got powerful intangible assets like brands or networks, and also an advantage of owning companies with high gross margins, we look to own companies that have pricing power, which is a defense against inflationary pressure. And actually, high gross margins are generally a strong indicator that you do have pricing power, because they wouldn't be high if you didn't have the pricing power. You wouldn't be able to maintain that high gross margin. And you know what companies with pricing power can do is they can offset the effects of input cost inflation via pass-through to the end consumer. But it's not typically instant. There's often a time lag, but the cost pressures do get recovered. And as you rightly say, that the degree of inflationary pressure across sectors and industries we own is different. It's very limited in software, for example. There's no real input cost pressure. But there might be, if it develops in the near term, if we start to see wage pressure because of a tight labour market. Not really seeing that yet, but it might come through. Input cost pressure is not really an issue for us in medtech or life sciences, but clearly input costs have risen for our staples companies recently across packaging and across ingredients. And we're seeing that in the reports coming out from Procter & Gamble or Reckitt Benckiser or Unilever or Nestle. They're acknowledging that there is, because it's been such a rapid spike, it's going to take a while for that to get through the system. There's this lag to recover it, but it does get recovered. But if you have a starting point like our companies do, where you have high gross margins, the temporary effect, the relative impact of inflationary pressure in terms of dropping through the P&L is naturally going to be less. But we are seeing, you know, when you have an historically very, very sharp and quick spike in commodity costs, even if you have pricing power, it will take a little time for that to work through the system and on into the end consumer, which then ultimately stimulates inflationary recordings even more. So there is a period of time that we're waiting for that to go through. But in principle, owning high quality companies that have the characteristics that we have means that you have a good weapon against the vagaries of input cost inflation. And from an alternative perspective, in a deflationary environment, being able to maintain and sustain your pricing is also very important. So pricing power works in both ways. Okay.
Ronnie, how is inflation affecting the Asian markets? Different from what we are seeing in some countries like US. China is not showing a lot of inflation on the CPI, but mainly on PPI. But I think in emerging Asia is showing some signs of inflation pressure. So how this is impacting the way that you invest?
So for us as technology investor in Asia, inflation is maybe a little bit less of a topic. Inflation, or when we look at the companies we are investing, they're usually kind of market leaders in their niche industries. They are producing key components which are in high demand, they are usually generating quite high margins thanks to that, and enjoy high barriers of entry for the competitors. So therefore, I would say when it comes to price increases, it's more defined by innovation. So just to mention an example, and our company we think is quite interesting is Acton Technologies, a mid-cap Taiwanese hardware company, and they just come out. What they are producing is a kind of key component for data centers. So their main customers are Amazon, Microsoft, Google, so all the big kind of cloud computing providers. And they are delivering components which allows them to increase the capacity of the data centers, increase the speed, and at the same time also reduce the cost of their running the data centers. And they just are going now in an upgrade cycle. So they come up with a new innovation, with a kind of latest release of a new product or a kind of an updated product. And what they can allow to increase the price by 4 times because their products are such in a high need. So the average selling price is 4 times higher than the predecessor product. They can do that because they are commanding a high market share of 60% and more. So this is a little bit more the kind of things what we see when you invest in kind of the market leaders. What we're more worried about, and also maybe then is a source of inflation for other sectors, is also when it comes to semiconductors. All these kind of bottlenecks we see currently in the global supply chain, kind of bottlenecks in semiconductor production, like in Taiwan, which is suffering from a several months long drought, for example, which when you're producing semiconductors, you also need in this process a lot of water. So these are the kind of things which are maybe then increasing inflation coming out from technology companies for other sectors. But for our companies, I guess it's more decisive how innovative they are, how large their market is or their market share is, and also respectively the kind of high barriers for entry they have versus other competitors.
Interesting. We are almost on the end of our presentation here, so I'm gonna do my last question here for Graham. Do you use macroeconomic variables on your models? And if yes, how does it work when you combine macroeconomics with microeconomics and market signals?
Yes, absolutely, we do. So the trend following vehicles we use are typically price-based. The macroeconomic side doesn't come into it. But we also have complementary multi-strategy vehicles and macro strategy vehicles that will exactly look at that into account. So take into account, GDP, for example, shapes of yield curve, for example, inventories when it comes to commodities. So we'll take into account all of these when coming up with our strategies. And they also feed into the inflation side as well. Inflation is something that it is driving a lot of interest in our strategies at both AHL and Man Group at the moment, simply because we haven't seen it for 50 years, but inflation has the potential to seriously dent traditional portfolios. Anything made up of equities and bonds, it's been a great environment for the last 20 plus years for 60-40, but inflation could put a serious hole in that. So we've obviously researched strategies that can work in inflationary environments. 2 stand out. One is futures trend, and the other one's a qualities stocks type strategy. What we've seen in our historic strategies, using various balance sheet metrics, is that long short quality is something that tends to work very well in inflationary environments. And we can also construct, using macroeconomic vehicles, inflationary strategies that can actually be sensitive to inflation. So you can look at consumer price inflation on regional basis. You can construct portfolios on a regional basis, consisting of, let's say, bonds, equities, and commodities. In an inflationary environment, the commodities would go up, the equities would go up, commodities would go up, bonds would go down, equities would go down. In a deflationary environment, it would be the other way around. So you can construct portfolios using macroeconomic vehicle information to really think about inflation and to be sensitive to what environments come up. So yes, we use macroeconomic vehicles. We use them in addition particularly right now, to help out with a lot of our inflationary type strategies and concerns there.
Thank you. We are coming to the end of the presentation. Alistair, Graham, and Ronnie, thanks a lot for the conversation. It was a great opportunity to understand a little bit your views regarding the global economy and global markets. I would like to thank Morgan Stanley, Wellington, and Main Group. The offshore market in Brazil is growing a lot the last couple of years, and these three management companies, they are offering very good products here in Brazil. So thanks again. Before ending here, I would like to give a special thanks for all the TAG investment team that made this event possible. And I think we are going to have 2 wonderful days here with a lot of material for our guests. Thanks a lot.
Thank you to our guests. It was a pleasure to have you with us here in our event. Thank you very much. Dan, thank you. Thank you. Obrigada, Dan. Para você eu já posso falar em português. Obrigada. Prazer tê-la aqui conosco. Realmente o time da TAG está de parabéns. Um evento incrível, super preparado, com muito carinho, repleto de conteúdo e ainda tem muito mais para vocês, tá? Então, aproveitem essa nossa breve pausa por aqui para ir tomar um cafezinho, passar ali na sala dos patrocinadores, garantir os prêmios. Afinal de contas, amanhã, no final do TAG Summit, temos muitos prêmios para vocês. Então, até já.